Quote of the day: "You must gain control over your money, or the lack of it will forever control you." Dave Ramsey. Welcome back to our channel, where we empower beginners with the wisdom of smart investing. Today, we dive into strategies for not just surviving but thriving in challenging market conditions. If you're ready to learn how to make great profits in bad times, you're in the right place. Segment 1: Navigating a bear market with mutual funds. First up, let's talk about surviving the storm of a bear market with mutual funds. These funds are a lifeline for investors during turbulent times. Understanding mutual funds in a bear market. In the tumultuous investing world, bear markets can be daunting, even for seasoned investors. These downturns can trigger fear and panic, causing many to contemplate withdrawing their investments. However, this is precisely where mutual funds shine as a valuable tool for investors. Diversification for stability. Mutual funds are designed with diversification in mind. In a bear market, diversification can be your best friend. A mutual fund pools money from various investors and spreads it across a broad range of assets, such as stocks, bonds, and sometimes even alternative investments like real estate or commodities. This diversification shields your investments from the brunt of market volatility. Professional management in turbulent times. One of the key advantages of mutual funds during bear markets is the presence of professional fund managers. These experts navigate the treacherous waters of the market, making strategic decisions on your behalf. Their extensive knowledge and experience can help steer your investments through rocky terrain. Liquidity and accessibility. Mutual funds also offer liquidity, allowing investors to buy or sell shares at the end of each trading day at the fund's net asset value, NAV. This means you can access your investments even during challenging times, unlike certain investments like real estate, which can be illiquid. Types of mutual funds in bear markets. During a bear market, you'll encounter various types of mutual funds tailored to different investment objectives. Bond funds. These funds primarily invest in bonds, which tend to be more stable than stocks during market downturns. They can provide a steady income stream. Balanced funds. These funds combine stocks and bonds in their portfolio, balancing growth potential and stability. Defensive funds. These funds focus on industries or sectors that are less sensitive to economic cycles. They aim to provide stability during bear markets. Inverse or bear market funds. These specialized funds use strategies that profit from declining markets. They can be suitable for investors with a bearish outlook. Advanced bear market strategies with mutual funds. For more advanced investors, bear markets present opportunities. Tactical allocation and market timing strategies can be employed using mutual funds. Tactical allocation involves adjusting your portfolio's asset allocation based on market conditions, while market timing involves making decisions to buy or sell based on predictions of market movements. Real-world success stories. Understanding mutual funds and their role in a bear market becomes even more powerful when we look at real-world success stories. Investors who stayed the course with mutual funds, rebalanced their portfolios and continued investing during bear markets often emerged stronger, taking advantage of the eventual market rebound. Mutual funds can be your ally during bear markets, offering diversification, professional management, liquidity, and various options tailored to your investment objectives. They can help you weather the storm while positioning you to capitalize on market opportunities when the tides turn. Remember that staying informed and making informed decisions are the keys to navigating bear markets successfully. Segment 2: Profiting from undervalued stocks. Now that we have addressed mutual funds, let's delve deeper now into the strategies for profiting from undervalued stocks, a compelling topic for investors seeking opportunities even in challenging market conditions. The allure of undervalued stocks. Undervalued stocks are like hidden treasures waiting to be discovered in the investment world. These are stocks whose market prices do not reflect their intrinsic value, and they often present tremendous potential for profit. However, identifying undervalued stocks requires a keen eye, thorough research, and strategic decision-making. Stock analysis, the first step. The journey to profiting from undervalued stocks begins with diligent stock analysis. Investors must examine a company's financial health, earnings potential, and market position. Key metrics such as price-to-earnings ratios, price-to-book ratios, and debt-to-equity ratios are crucial in assessing a stock's valuation. If you need more information about key financial ratios, please refer to the video we made about in this channel. Value investing and contrarian approaches. Two primary investment strategies are commonly employed to profit from undervalued stocks: value investing and contrarian investing. For value investing, investors seek stocks that are trading below their intrinsic value. This approach involves identifying stocks that are currently out of favor but have strong fundamentals. Investors like Warren Buffett have famously embraced this strategy. See also the Intelligent Investor video to understand more about value investing and how Warren Buffett got inspired by that book. Videos in the description below. Contrarian investing. Contrarian investors take positions opposite to prevailing market sentiment. When everyone is selling, contrarians buy. When everyone is buying, they may sell. This approach assumes that the market often overreacts to news or events, creating opportunities for savvy investors. There's also a famous quote by Warren Buffett about that approach. Quantitative and qualitative analysis. To pinpoint undervalued stocks, investors must conduct both quantitative and qualitative analyses. Quantitative analysis involves crunching numbers and examining financial statements, while qualitative analysis delves into a company's management, competitive advantage, and growth prospects. Successful investors combine these approaches to make well-informed decisions. Undervalued stocks versus value traps. While seeking undervalued stocks is enticing, it's essential to differentiate between genuine opportunities and potential value traps. Value traps are stocks that appear undervalued but remain stagnant or decline further. Thorough research and a deep understanding of the industry are essential to avoid falling into value traps. To illustrate the potential of profiting from undervalued stocks, it's valuable to explore real-life success stories. These stories showcase investors who identified undervalued companies, invested wisely, and reaped substantial gains when the market recognized the true value. The art of identifying undervalued stocks. Profiting from undervalued stocks is an art that requires a blend of analysis, strategy, and patience. Investors who master this art can potentially unlock significant wealth-building opportunities, even during challenging market conditions. Remember that thorough research, a long-term perspective, and a commitment to continuous learning are your allies on this rewarding investment journey. Segment 3: Defensive Investment Strategies. Let's address now the segment on defensive investment strategies, which can be a crucial part of profiting during challenging market conditions. The role of defensive investment strategies. In times of market turmoil, defensive investment strategies come to the forefront. These strategies aim to minimize losses and provide stability to an investor's portfolio, making them valuable tools for investors seeking protection during bear markets. Dividend stocks, a steady income stream. One key component of defensive strategies is investing in dividend stocks. These stocks belong to companies that consistently distribute a portion of their earnings to shareholders in the form of dividends. Dividend-paying companies often operate in stable industries, making their stocks less susceptible to market volatility. Investors seeking a steady income stream during market downturns can benefit from dividend stocks. These companies' ability to generate consistent cash flow can help cushion the impact of falling stock prices. Additionally, dividend reinvestment plans, DRIPs, allow investors to reinvest dividends automatically, compounding their returns over time. Utility and consumer staples stocks, defensive sectors. Utility and consumer staples stocks are often considered defensive sectors. Utilities provide essential services like electricity and water, while consumer staples encompass products like food, toiletries, and household goods. These industries tend to remain stable regardless of economic conditions as people continue to use their services and buy essential products. Investors looking for stability in their portfolios during market downturns may allocate a portion of their investments to these sectors. Utility and consumer staples stocks can act as defensive anchors, helping to offset losses in more volatile sectors. Precious metals, safe haven assets. Precious metals, particularly gold and silver, have historically been regarded as safe haven assets during times of economic uncertainty. When the stock market is in turmoil, investors often turn to precious metals as a store of value and a hedge against inflation. The prices of precious metals tend to rise when traditional investments, such as stocks, decline. They provide a level of diversification and stability that can help protect an investor's overall portfolio. Charts illustrating the historical performance of gold and silver during bear markets can visually highlight their role as safe haven assets. In summary, defensive investment strategies are essential components of a well-rounded investment approach, especially during challenging market conditions. Dividend stocks, utility and consumer staples stocks, and precious metals offer investors stability and the potential for continued growth even when the broader market is struggling. Incorporating these defensive elements into a portfolio can help mitigate losses and provide a sense of security in turbulent times. Segment 4: Hedging Techniques. Let's dig into the segment on hedging techniques, which can be invaluable for investors looking to protect their portfolios during market downturns. Understanding hedging techniques. Hedging techniques are financial strategies employed by investors to mitigate the impact of adverse price movements in their investments. In essence, hedging aims to reduce risk and protect the value of a portfolio, particularly during turbulent market conditions. Options trading, a versatile hedging tool. One of the primary tools in hedging is options trading. Options are financial derivatives that provide investors with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, strike price, within a specified period, expiration date. Protective put options, a common hedging strategy involves purchasing protective put options. These options give investors the right to sell an underlying asset at a specified price, protecting the value of their holdings if the asset's price falls. It's akin to purchasing insurance for your investments. Covered call options, another strategy involves selling covered call options on stocks you own. This generates income in exchange for agreeing to sell your stock at a specific price, potentially offsetting losses if the stock's price drops. Inverse and leveraged ETFs, profiting from declines. Inverse exchange-traded funds, ETFs, are designed to profit from declining markets. These ETFs move in the opposite direction of a particular index or asset. For instance, an inverse S&P 500 ETF would rise when the S&P 500 falls. Leveraged ETFs amplify returns, either on the upside or downside, by using financial derivatives. For example, a 2x leveraged inverse S&P 500 ETF would aim to provide twice the inverse return of the S&P 500 on a daily basis. Fixed income investments, stability amid volatility. Hedging can also involve allocating a portion of your portfolio to fixed income investments, such as bonds and treasury securities. These assets tend to be less volatile than stocks and can act as a source of stability during market turbulence. Risk management strategies. Effective risk management is an integral part of hedging. Investors should determine their risk tolerance and establish clear risk management guidelines. This includes setting stop-loss orders to limit potential losses on individual positions, and regularly rebalancing portfolios to maintain desired asset allocations. The chart depicting the historical performance of hedging strategies in bear markets can illustrate their effectiveness in reducing portfolio volatility and protecting capital. Hedging techniques are essential tools for investors seeking to protect their portfolios during market downturns. Options trading, inverse and leveraged ETFs, fixed income investments, and diligent risk management strategies provide a range of options to safeguard investments. While hedging comes with its own complexities and costs, it can be a valuable component of a comprehensive investment strategy, offering peace of mind and a measure of protection in turbulent times. Segment 5: Behavioral Finance and Emotional Management. Last but not least, the segment on behavioral finance and emotional management, a topic that plays a pivotal role in helping investors navigate challenging market conditions. Understanding behavioral finance. Behavioral finance is a field that explores how psychological factors influence financial decision-making. During periods of market volatility and uncertainty, understanding and managing these psychological factors become critical for investors. The role of emotions in investment decisions. Emotions, such as fear and greed, often play a significant role in investment decisions. During a bear market or economic crisis, fear can drive investors to panic and sell assets at lower prices than they paid, locking in losses. Conversely, greed can lead to overconfidence, causing investors to take excessive risks. Staying disciplined during turbulence. One of the primary challenges investors face during market downturns is staying disciplined. It's crucial to stick to a well-thought-out investment plan rather than making impulsive decisions based on emotions. Implementing predetermined stop-loss orders and target allocation percentages can help enforce discipline. The importance of a long-term perspective. Bear markets are often part of the natural ebb and flow of financial markets. A long-term perspective can help investors weather these downturns. Historical data shows that markets have eventually rebounded from bear markets, often reaching new highs. Visual representations of market performance over time can provide reassurance. Stress testing your portfolio. During periods of market stress, it's beneficial to stress test your portfolio. This involves evaluating how your investments would perform under various adverse scenarios. Stress testing can help identify potential weaknesses and allow for adjustments before market conditions worsen. Learning from behavioral biases. Behavioral finance identifies various cognitive biases that can affect investment decisions. These biases include overconfidence, confirmation bias, and loss aversion. Recognizing these biases in oneself and taking steps to counteract them can lead to better decision-making. The role of financial advisors. Financial advisors can be invaluable during turbulent times. They provide an objective, outside perspective and can help investors stay focused on long-term goals rather than short-term fluctuations. To emphasize the importance of managing emotions and maintaining discipline, real-life success stories of investors who weathered market downturns and emerged stronger can be shared. These stories highlight the potential rewards of maintaining composure during challenging times. As first example, Warren Buffett, the Oracle of Omaha. Warren Buffett, often referred to as the Oracle of Omaha, is one of the most renowned investors in the world. His success story includes his ability to remain disciplined during market downturns and capitalize on opportunities when others were fearful. During the 2008 financial crisis, Buffett's Berkshire Hathaway invested $5 billion in Goldman Sachs, a move that provided vital capital to the struggling bank at a time when many were avoiding financial institutions. This investment not only helped stabilize Goldman Sachs, but also generated significant returns for Berkshire Hathaway as the financial sector recovered. 2. Sir John Templeton, a legendary contrarian investor. Sir John Templeton, another legendary investor, was known for his contrarian approach and ability to find value in the midst of market turmoil. During the Great Depression, Templeton famously purchased 100 shares of each of the 104 companies trading for less than $1 on the New York Stock Exchange. Many of these companies were distressed and facing bankruptcy. However, his diversified approach paid off handsomely as the market eventually rebounded. By the end of World War II, he had turned his initial $10,400 investment into nearly $40,000. 3. Peter Lynch, the Magellan Fund. Peter Lynch, a successful mutual fund manager, managed the Fidelity Magellan Fund from 1977 to 1990. His approach was to invest in companies that he understood and believed in, regardless of market conditions. During the 1987 stock market crash, Lynch famously advised investors not to panic during the market crash and even encouraged them to consider buying. He stated, "The real key to making money in stocks is not to get scared out of them." The Magellan Fund bounced back quickly after the crash, and Lynch's long-term approach rewarded investors handsomely. 4. John Paulson, betting against the housing bubble. John Paulson, a hedge fund manager, is known for his incredibly successful bet against the U.S. housing market during the mid-2000s. During the subprime mortgage crisis, Paulson recognized the unsustainable nature of the housing bubble and placed bets that would profit if the market collapsed. His hedge fund made billions of dollars in profits during the crisis, demonstrating the potential for investors to profit from market downturns by recognizing and capitalizing on systemic weaknesses. These real-life success stories underscore the importance of staying disciplined, having a long-term perspective, and being opportunistic during challenging market conditions. While not every investor will achieve the same level of success, these stories serve as inspirational reminders of the potential rewards of smart and strategic investing during bear markets. In conclusion, behavioral finance and emotional management are critical components of successful investing, especially during bear markets and economic crises. Understanding how emotions influence decision-making, staying disciplined, maintaining a long-term perspective, and learning from behavioral biases are essential for investors seeking to protect their portfolios and capitalize on opportunities. By mastering these aspects, investors can navigate turbulent times with confidence and resilience. That was our video about strategies to adopt during bad market while making profit. Don't forget to subscribe to our channel and give this video a thumbs up if you found it valuable. By doing so, you'll stay updated with our latest insights and strategies. Stay tuned for our next video, where we'll dive deeper into investing strategies for beginners. We'll uncover more gems to help you build wealth and navigate the financial markets with confidence. Thank you for joining us today on this journey of financial wisdom. Until next time, happy investing.